In this video, we're going to be talking about something called the VRT plan, or something called volume reaction trading. Most traders are unsuccessful in the markets because they try to predict where price is going to go next. And as we know, in any financial market, the markets are almost completely unpredictable and they're almost in a random walk. What we're going to be talking about is something called volume reaction trading. Instead of trying to predict where price is going to move, instead, what if we could just react to what the price is doing instead and be able to catch these moves instead of trying to predict them? So what we have is a special guest here. This is Yuya Kato, who's starting to publish more on our channel. He's one of the best traders that I know. He's a 15-time funded professional prop trader, and he's somebody that actually does this for a living, has been very, very successful. So Yuya, thanks so much for being on the channel again. Hopefully people are getting to know you a little bit, and I know we have a great series of 6 videos planned out over the next 6 weeks. Why don't you go ahead and explain to people why volume reaction trading and how you founded this, and what is it? A bit about what it is and how people could use this to their benefit.
Thank you for having me on. Yeah. So for the VRT cheat sheet, how I kind of came up with the idea, right? Like what Adam said, instead of predicting the market, I've learned to actually react to the market. When I first started trading, I was always trying to predict where the market was going because you always wanted to be that guy that could predict the 200-300 pip move, right? And I've realized every time I was trying to predict the market, all that left me was a 50-50 win rate, right? And even though you have a 50-50 win rate, and you can still be successful, you have to realize that every trade you take has like a damaging effect on your psychology, whether it's negative or positive, right? So I started to realize that like if I'm able to react more and get in and out of trades a lot quicker, it was a lot better for my psychology. And I always tell a lot of people this, right? 90% of your trading is psychology. The 10% is the technical analysis part, right? And I truly believe that within a day or two, you can get down that whole 10% down, right? The 90%, the psychology part, is going to take experience, it's going to take you putting the time in the market and failing, right? I always tell people this as well too, is that your losses is what really helps you become a consistent and profitable trader, right? A lot of people are afraid of losing, but the thing is, if you don't lose in the market, you're not going to be able to really refine your psychology. So this whole concept of the VRT was just created when I first got here to Japan and was able to trade at these peak time hours and understood how the market was moving in those times. And what it helped me with was that I didn't have to predict what the market was doing. I was able to sit on my hands and wait for a movement to happen. And that's essentially, the reason why I was able to create like a cheat sheet in this manner, and be able to kind of, execute in the live markets.
Fantastic. So can you show an example of what you mean, like when the ideal times to be in the market is and when volume's actually happening?
Yeah. So let me just bring up my screen here. So we have, a pair that I love to trade, GBP, JPY, which is the British pound against the Japanese yen, right? So I have these session breaks. So as you can see, in yellow is the Tokyo and the Sydney and the Tokyo Open, right? So the yellow and the red combined is what we call Asia session, right? So during those sessions, I usually sit on my hands and let the market move, right? So the big thing about this VRT, cheat sheet is you want to find where the big candles form, right? So sometimes they do form in the Asia session, but most 9 times out of 10, they form during either the London or the New York, right? And you also have to think about what pairs you're trading. So if I'm trading the British pound against the Japanese yen, I obviously want to trade in those sessions when those two banks are open, right? This whole concept of the London Open is why I like to trade GBP JPY, is because you get the crossover of the Tokyo session with the London session in the first hour of the open, right? For me, the open happens at 4 p.m. So this is the 4 p.m. candle. And then essentially this is, a 5 p.m. candle. So in that 1 hour is usually where I like to trade. And sometimes, like I said, during the Asia session, you do move. That's the pre-London aspect. So you always just have to find out where the big candles form during these times, because that's when you want to be in the market. Because for me, like I always said, you can only really react to the market when the market is really moving, right? When it's kind of creating a consolidation stage and doing nothing, you really can't do anything because all it's going to be doing is just bouncing up and down. So you really just want to be in the market when there's the big engulfing candles. And what I mean by big engulfing candles is simple. The big bearish candles or the big bullish candles. That's when you really want to be in it. And if you kind of look at just, you can put this indicator on, but if you look at at it, you can kind of see the big movements happen during like the London session for GBP, JPY. And that is the reason why I started to just trade at a specific time for a long period of time. And I created that consistency for myself. Essentially, at the end of the day, you want to find those peak time hours because it's going to give you the best opportunity. And it's also going to help you preserve your psychology. And what I mean by preserving psychology is that you're thinking about trading as a long-term thing, not a set destination. You always have to think about the journey that you're taking, and trading at these peak time hours has given me the peace of mind to be able to overcome these losses and be able to create a consistent plan for myself, because usually I'm in and out of a trade in 10 to 15 minutes, right? That's like the best thing possible. Even if it hits your stop loss in 10, 15 minutes, you're able to kind of just, not have to take that much of a damage to your psychology because it was a quick trade, right? Essentially, at the end of the day, you can have these like indicators on to kind of back test like when these markets move. But for myself, I've realized that if I'm trading a pair like GBP, JPY, I like to typically trade it when the banks basically open and are at, high peak volumes.
And so is it fair to assume that if you want to trade, a different pair, let's say that you want to trade a US dollar pair, that you should be trading at the New York session open?
Correct. So let's take a look at a pair like, gold right here. So is a unique pair. So these are the two pairs that I really like to trade, is gold and GBP, JPY, right? Gold, it has the USD currency, right? So typically the USD currency, you want to trade it during the New York sessions, right? So the New York session is when the US market is open. But also the thing about gold is that it can move in all three different situations, like all three sessions, right? It also can move in the Tokyo session, the London session, and the New York. But typically I like to trade the gold or any pair that involves USD in the New York session because it typically will move there and you'll get a more smoother move, right? And sometimes like this right here, like yesterday, it basically did move during the London session. And I do trade gold at times during the London session, but only if there is an right opportunity. It has to be more of a higher probability trade, just because of the fact that usually in the London session, I like to reserve all my trades for GBP, JPY, since that's the session that it should be moving the most at, right? So typically with any pair that involves the USD, I typically like to trade the New York session. And then if you are going to trade the indices, 100% just trade during the NYSE open, which is essentially the 9:30 a.m. Eastern candle, right? That is basically when the stock exchange opens, and that's when you want to be trading the indices.
So putting this together so far, right? The idea is to get in when the market's moving, so you're not sitting in these trades for a long time and it's eating away at your psychology. You're getting in when there actually is volume. Generally, you're trading right at the market open, either, London or New York Stock Exchange open, because this is when the most volume is coming. And I know that you're really big on teaching people to only trade a couple of pairs or one or two pairs. Why is that?
At the end of the day, you want to keep things simple, right? The more simple you can keep things, the easier it becomes to actually stay on that path and be consistent. And the whole goal of trading is consistency, right? You can't really I don't truly believe you can be consistent by trading 10 to 15 different pairs. And the reason why I can say that is I used to trade 10 to 15 pairs, right? When one pair didn't have a setup, I would try to go to look for another pair. And all that did was basically like literally drain my mind and drain my psychology. It was a very hard thing to do. So yeah, I might have all these different pairs, but like, all these pairs I'm just looking at, right? So I have gold and GBP. They're at the top of my, pair. And usually I'm only trading these two, for the past, I would say 5 to 6 months, I've only really traded these two pairs, right? I look at, USD JPY because I do live in Japan, right? I want to see how the yen is doing. US 30 and NASDAQ are the indice pairs. So if I do trade the NYSE, I strictly usually just trade them. And then Bitcoin, obviously, because it's just a crypto, right? So essentially at the end of the day, I'm only really looking at these two pairs and seeing how they move. If there is no setup there, I take no trade. It's simple as that. I think we have this mindset of like, we have to enter a trade every time we hop onto the charts. And that's the worst mentality to possibly have, because all that's going to do is lead you to create bad habits, force trades, revenge trades. All these bad habits come when you're trying to like force a trade every single day, right? For me, I used to take 15 to 20 trades per week, right? Because I was trading 10 different pairs. But then I started to realize that it was such an emotional and also a mentally draining thing for me, because I would lose, then I would win. I would lose, then I win. I would go on a win streak, then I would go on a huge losing streak. I was just thinking, what can I do to avoid this, like, you know, emotional roller coaster that I'm going to? Then I just started to just understand that, like, you know, these two pairs moved at very specific times. And the whole end goal of trading is not to be staring at your screen for the whole day, right? You want to just, you know, dedicate a few hours a day. And for me, it's literally only 2 hours a day that I dedicate, you know, trading. Essentially in that 2 hours, you can make, you know, honestly, someone's yearly salary. And that's a crazy thing to think about, right? So I usually just trade GJ during the London, gold during the New York. And it's really simple. That 1 hour of each session, I try to look for an opportunity. If that opportunity does not present itself, I then, you know, call it a day and then come back, you know, the next day. And I think that's the huge, important, like, wow moment that I had, is that, like, I really like this way of trading because it gives me, you know, the time and freedom to do the things that I want. And that's the reason why, you know, we decide to trade anyways, is to, you know, obtain that freedom and do the things that we want to do.
Yeah. Absolutely. And by the way, if you guys would like to trade with Yuya in the morning, then go to fundedtraderfasttrack.com and you can have the opportunity to fill out an application to actually trade with him and his team in the mornings. So lastly, Yuya, I know we're going to be talking in a future video about, you know, entry criteria, exit criteria, kind of more, you know, detailed stuff. Will you just talk really quickly kind of about how you view your risk management on your trading plan? And then that little equation that you're so big on, V plus V equals M. Would you explain like what that means to people?
Yeah, of course. So essentially, you know, when I get onto the charts, I like to first look at the bigger time frames, right? So I think about it as in terms of like a book, right? Chapters, right? So like the biggest time frame that I usually look at would be the daily. So typically what I like to do for this, you know, this concept is I like to look at what the previous day candle has done. So if we look at this candle right here, we look at it, we kind of just think, okay, what did this daily candle do? And if you can't figure out exactly what this daily candle is, and it's kind of like, you know, a confusing candle, then this concept of chapters come along, right? So like you have the title of the book, which is like the daily, right? You might not understand, you might get a small glimpse of what the book is talking about, but you might, okay, I don't know the details, right? I don't know the characters and all that. So that's when you start dropping down to the lower time frames, like the 4 hour. Then you look at the 6 4-hour candles that form the one daily candle. And then you look at, okay, what did it do? So if we're just looking at, you know, the previous 6 candles right here, we're seeing, okay, this looks like a mess, right? It's going up and down, up and down. We don't know what that is. So we need a little bit more details. So we don't then go down to the 1 hour candle and then look at, see what the 1 hour candle's done. Right here, it's the same thing. It's kind of going up, it's going down, it's going up, it's going down, but there's a huge spike right here. What caused it? Then you go on like you know, websites like Forex Factor to see if there's any type of news. And yesterday there was a CPI news which caused this. So you're like, oh, this makes sense. And right now it's still trapped in that range that CPI was creating right here. You know, there's nothing that we can do with that. After seeing that, you're like, okay, I still don't know which way it's going, right? Then you start dropping down to lower time frames, right? And then as you go down to the lower time frames, this becomes dangerous because people go on lower time frames during times where market does not move, right? And that's when you don't want to be on the lower time frames, because consolidation, you know, phase of low volume could literally easily stop you out. So I'm only going down from the 30 to 15 to 5 at those high peak hours that I was just mentioning, right? The London session, the London Open, or the New York Open, or the NYSE Open. And from there, all I like to do is just go down and see what the 30-minute candle is doing, identify my ranges, and then look to execute based off of the 15 or the 5. It's really that simple. For me, how I like to execute trades is if I'm taking certain trades, right, I risk either 0.5% of my account or 1% of my account. You know, and I have this rule for myself. I don't want to lose more than 1.5% for that session. If I lose 1.5 for that session, I call it a session. I don't go into a trade again until the next session, which would be if I lose 1.5 during London, I would wait till the New York session to enter a trade again. That is a way that kind of keeps me from revenge trading and losing more of my account, right? A lot of people can't accept losses and can't walk away. That's the one thing that has helped me create consistency. I would believe that being able to walk away from a loss is one of the biggest components into being successful as a trader. So I want you guys to remember that, right? And lastly, my favorite equation, right? And the reason why this volume, the VRT cheat sheet works, is this equation of how volume plus volatility equals momentum, right? So momentum is my favorite word in Forex The reason why is in anything in life as well too, you want to ride that momentum, right? Where people start becoming successful or you start seeing, NBA teams catch a run is because they create momentum for themselves, right? So this aspect of volume plus volatility equals momentum is a beautiful formula to kind of keep in your head because it makes everything that simple, right? The volume aspect is when we, break down the sessions, right? You want to trade during the high volume sessions, whether it's a London, the New York, or the NYSE. You can control when you trade with volume, right? Because that during those 3 sessions, you're bound to get some volume. The volatility aspect is essentially a range you identify, and then you essentially wait for a break of the high or the low. When anything is breaking, when a consolidation zone is breaking, volatility is in the market because it needs that little spike, right? It needs that volatility to be able to push it into one direction. Another aspect of volatility is like red folder news, right? When red folder news come into the market, there's a lot of volatility, So in order for you to take a trade, you want to implement both volume and volatility because when you combine these 2 things together, you create momentum. And this is the aspect of reacting, right? You want to react when you see the momentum, right? So typically you can anticipate a big move happening once you start seeing volume and volatility in the moment, in the market, but not every time is it going to create momentum. That's where the reaction comes to. So you can wait for the volume, which is basically the session opens. The volatility is either the high or the low breaking or red folder news happening. And then from there with all the other, trading strategies that we do have and also the candlestick patterns we look for, you then look for the momentum, right? There's a lot of candlestick patterns we look that basically equal momentum. So in these next future videos, I'll definitely be teaching about all the different candlestick patterns, but this is definitely a formula that I want you guys to remember because this formula has allowed me to keep things simple. And if you can keep things simple, you can create consistency for yourself.
Hey, if you thought this video was helpful, then make sure you like and subscribe and also turn on the post notifications. We're going to be coming out with a new video each week where Yu's going to continue to build upon this, where he's going to be talking about what he uses to enter. He's going to be talking about his favorite candlestick patterns. All of this is coming shortly, so make sure that you stay tuned for that. And also, we have some other helpful videos on the screen right now.